panel members now that they are seated on the panel. To my far right, we have David Wright, Chairman of EUROFI. Beside him, Dominique Laboureix, member of the board of the Single Resolution Board here in Brussels. Then Mr. Axel Weber, Chairman of the board of UBS Group. And finally, to the right of myself, Mark Branson, Chief Executive of FINMA, the Swiss supervisor. I'd like to thank Thomas for the very good introduction he has given with the overview of the discussion paper. Certainly, working through many of these issues over the past years, it seems quite commendable that all the reforms have been able to be squeezed into a single slide chart. But the idea of the first panel is to run through some of these regulatory initiatives. The financial crisis clearly has led to a very intense regulatory exercise, has forced banks to adjust, and they have led to enhanced resilience and resolvability of the financial system, and then better overall management of risk. The panel will be exploring briefly what has been achieved. Are there areas that are still open or need to be looked at? How can we identify or achieve greater regulatory efficiency gains, and also, as is becoming clearer now, the unintended effects of ring fencing of financial resources. Regulatory fragmentation is increasing, and inconsistent implementation of global standards could also lead to the undermining of the global financial stability that was achieved. I would leave it there as an introduction. I think the task before us is very clear. The first question to the panelists, and I think here it's perhaps for the regulatory community to react first, in the sense of has the task been achieved? Have you been able to implement the full range of what you intended or what you believe to need? And I think it makes sense to start with a supervisor first and foremost, and then perhaps hear the view from somebody in resolution, dealing with the potential resolution of banks. So, Mark, if I may ask you, have the reforms been implemented, and are you satisfied?
Well, I think we're paid to be professionally dissatisfied. Declaring victory is not something that we have in our vocabulary. And I do also believe it would be premature to declare victory over the sort of too big to fail problems which haunted us a little more than 10 years ago. So, you know, what's obvious is that very much has been remediated, that the most egregious miscalibrations in the regulatory system, the prudential regulatory system, have been corrected, that most of the capacity that of the extra capacity to absorb losses and liquidity crises has been already built, not all, but most of it, and we're well underway, I think, to over the next few years, completing the build-up of the buffers that are necessary to create the loss absorbency in the system for a potential repeat of heavy exogenous shocks. A lot has been done, and a lot of desired effects have crystallized. There is a fatigue natural in every marathon, Somewhere around kilometer 32 to 33, you realize you're tired, but there's still 10 kilometers left. The last kilometer's okay, but we're not quite at the last mile. We saw the difficulty we had to get Basel III over the finishing line internationally. That happened finally just a bit more than a year ago, but that's not over the finishing line nationally. So all of the jurisdictions have implementation work still to do. And putting my resolution hat on, both nationally and internationally, it's pretty clear that most of the global systemically relevant institutions are still have improved their resolvability significantly, but are still not at the point where we could say that yes, we could plausibly resolve them in all foreseeable or plausibly foreseeable circumstances. So there's also a journey on the resolvability side where we are certainly over halfway on that journey, but haven't reached the goal. I'm sure you'll come back to the question about what is the appropriate cost of that journey, and have, when we look back, can we reorganize what has been done to take out some of the complexity that drives cost? But we should never forget why we set out on the journey in the first place. And so a simple listing of everything that's been done as though that only goes on the debit side is of the sort of, when we're looking at the common good and looking back at the crisis, I think is a little bit short-sighted, because we have to put on the credit side a massively reduced chance that we have to experience what we experienced about 10 years ago.
Dominique, how do you perceive that? Do you feel it's become feasible to resolve a large bank in the European Union with the rules that have been put in place, or is supervision now so much improved that it's a relatively easy job to hold down?
Well, I don't know if I can make such a judgment, but what I know is that efforts have been made, as recalled by Thomas, on the regulatory side, at the same time on the going concern basis and for the gone concern times. And I think we've tried to make the banking system more resilient in reality to avoid potential future crises. And when we can be confronted to such crises, we are better equipped to try to give answers adequately to these crises. And something which was not mentioned here about the changes on the regulatory side is also the changes on let's say, the supervisory world. And for us, it's very important in Europe, because not only we've decided to implement a new regulatory framework, but we have decided to create what we call the banking union, with a new organization within 19 members, with a pillar in charge of supervision in Frankfurt and a pillar in Brussels in charge of resolution. So not only we've been given new tools and reinforcing our powers, but we have created the bodies in charge of implementing these decisions to be more efficient and better prepared. So I think indeed progress should be acknowledged on all sides. Obviously, once we have these elements in place, the key question now is the implementation phase, and I think the analysis conducted by the FSB about the implementation of all these rules, in particular on the resolution side, is critical. Not enough to speak about bail-in, to speak about TLAC, to speak about MREL resources, but we need to be sure that we can use them at the right moment and without meeting impediments which could make our decisions unavailable or at a minimum inefficient, or in some context even confronted with legal obstacles. So that means that we need to consider as Mark said, that we are not at the end of a journey, for sure. It's a collective effort, and the banking system has an enormous role to play to make it resolvable, not to prepare for its death, but to be ready to withstand measures which can help to ensure this famous financial stability we would like to preserve. And indeed, for that, there is this question of building loss-absorbing capacity. It was mentioned during the presentation. It's a new paradigm. We don't need only capital for going concern activities. We also need resources to be used to absorb losses and recapitalize the bank after a decision of a resolution scheme. It can be an impediment, in particular today. We know that some banks are not yet ready to gather all the resources needed or considered as needed to be in a good position to withstand such a decision, a bail-in decision. But I would like to insist about the journey, which is not only made of these capital or liquidity requirements, they are also made of other elements. And impediments to resolvability is a phrase which means, in reality, much more than only financial resources. It's also a structural issue. It's also an organizational issue. And banks have to work. You mentioned governance. Thomas, you mentioned governance. And I think governance in resolution is also, for resolution, is also something extremely important. So, better prepared for sure, ready to withstand shocks for sure. Are we at the end of the journey? Certainly not yet, and still efforts to be made on a number of areas.
Thank you. Then perhaps Axel, from the industry point of view, you've seen the rule book change significantly. Do you feel the rule book is now at a complete level, satisfactory level, and perhaps also to pick up on the point that was made earlier by Mark in terms of the sort of the cost side of regulation. Impact assessment is frequently mentioned. If I could have your views on that, and then perhaps David similarly after that.
Well, having been part of the regulatory and supervisory community, at least during a large part of the global financial crisis, I must say none of the banks that I talk to, and I also sit in many meetings of the IIF, question the direction of travel, the fact that more capital, more liquidity, some obvious weaknesses needed to be addressed, and were addressed actually as a first priority by many of the banks. I'm now in my 8th year at UBS, and over these 8 years, we've done nothing else than raise capital, improve liquidity, improve resolvability. It's not really a marathon, it's more like the peeling of an onion where you discover new layers every time you remove one. And if it were a journey that was where you set your sat-nav and you follow a clear destination and you know you're 80% of the way, that's an easy one to do. But this is an evolving journey where basically the objectives and also the targets change as we go along. And that has made it difficult for the industry to keep on top of things. Capital, liquidity, better resolution plans for group, resolution plans for subsidiaries, then funding in resolution. You're going deeper and deeper into the details of how you do this. It's important to have planned it and to have plans available, but I have my doubt, having sort of done a lot of resolutions and recoveries in the last crisis, that these very detailed plans are implementation rule books. They're more training exercises where, you know, in the end, nobody will say, here's the plan, let's do this. People will more likely say, we've exercised this a couple of times, everyone knows what to do, let's get it done. My working assumption is, if there is another financial problem in major institutions, resolution is the base case. I think recovery in many of these cases can only come about if a third party steps in. Resolution for a standalone institution, most likely when there is a gone concern case, is the standard case. And for that, I think it is important that we have some resolution funding at a central entity rather than each and every institution providing initial funding in resolution to the full degree that they're resolvable with their own resources, because that would be optimizing financial institutions for their demise rather than designing them to be profitable. Let's not forget one thing. The first layer of defense against any institution-specific problems is not capital, it's profitability. Capital is the second defense line. And very often what we're lagging at the moment in the European banking industry as compared to the US is a layer of profitability that can be basically tapped when there is problems. And I think it partly reflects the difference in markets. Basically, capital markets are back. If you look at where we are now relative to 10 years ago, all US banks profit massively from their large and deep and complex domestic financial markets, in particular capital markets. Europe doesn't have such a capital market. Actually, when I talk to Jonathan Hill, who now advises us at UBS, the largest capital market is about to leave the Union. And we haven't really prepared in Europe for replacing it with a dynamic capital market. We have a fragmented capital market as a result because all major financial centers, Paris, Frankfurt, Rome, everyone will benefit somewhat from the departure of the UK, but there will not be a single European financial capital that will be the new capital market. Now, that makes it very hard for European banks, in particular for the wholesale banks, and those are usually the ones we talk about when we talk about too big to fail, to be very, very profitable. So Europe has some specific problems that we need to also address if we want to make resolution credible. And you can see it, with, as Dominique will probably tell you, last time around when we had some problems in Europe, we were lucky that first, these were smaller banks, and second, that there were large domestic players that could play a role in the resolution, so they came to the help. Had that not been the case, had it been one of the larger banks, it would have been a much tougher exercise. So I think we also need to address some of these issues. How can we make sure the banking industry remains profitable so that they can actually stand on their own and have the right funds available to basically gear the bank to the future? I must tell you, we're now at the front end, probably already lost some space, of new technology in banking, making the old banking model completely redundant if we don't invest into the future. At this point in time, we're earmarking a lot of our capital and profitability for raising capital and being more resolvable. We don't invest it into technologies of the future. We don't invest it in cyber resilience. And that will come to haunt us. So I think, I'm absolutely in line with what regulators say, the journey is not over. But maybe we should take a more balanced approach between profitability of banks, competitiveness of banks, and resolvability and capital strengths, rather than, in my view, erring a bit too much on the side of solidity at the expense of profitability and dynamism in the European markets. That's the only thing that I would say where the balance is not right. I'm not saying the direction of travel is right or wrong or the speed is wrong, but I think the balance between those two measures should be brought back more than it is now, and that would be my only plea. And I think impact assessment and cumulative impact assessments and what have we achieved and what will additional measures bring should really be at this stage where the marginal benefit of additional regulation is naturally declining and where the marginal cost of additional regulation is likely to increase. That should be a key part of our discussion, what we further need to do. And that's not necessarily a plea for not doing anything or doing less, but it has to be targeted and it has to bring stability benefits that are clear and identifiable relative to what we've already done.
David, I think when you were still in the European Commission, financial crisis erupted, you weren't quite sure what was in place, where certain assets were. Now that all the rules are there, quantitative impact assessment for the comprehensive element rather than the individual bits that have been put on the table. What's your view on that? Would it be feasible? Is there scope to do that?
Well, thank you, Robert. Thank you for the invitation and also to be on this distinguished panel. And I very much agree with the sentiment of all three of our previous speakers. We've got to keep in mind here that this financial crisis costs the world, estimate 15 to 25% of global GDP. Those aren't my figures, those are figures used by the FSB. And we see massive economic dislocation, disruption. Just look at debt in Europe, public debt up around 30 to 40%. So the system needed some pretty radical surgery. And my judgment would be, and I think it's the sense of all of us, is that there's been very considerable progress. There's far more capital. Thomas's slides showed that there was 8 or 10 times more in the system. The derivatives markets are undoubtedly safer. It's not all finished, traded on exchanges, cleared and so forth. But it's much better than it was with massive notional exposures. Perhaps on shadow banking, so-called shadow banking, I know people don't like that terminology, but that was the terminology that was used. Perhaps there's less progress, and I want to come back to that in a second. Corporate culture, I think, is changing. I think the FSB and the global institutions didn't pay enough attention to that at the beginning, and the firms that failed, let's go back to them. Some of the corporate governance in those firms was lamentable, absolutely lamentable with incompetent people on the board. So I think that's changing, and that's really important that it does change. I would put this as one of the most important vectors. Have we got all the incentives right in the system? It's better, maybe not all. We still don't, in my view, have adequate data or adequate understanding of the complex financial markets that we live in. And let me, if I may, just quote President Draghi of the Central Bank, European Central Bank. He says, maintaining an interconnected financial system requires the availability of detailed, granular, transactional data able to link across markets, infrastructure, and counterparties. I would argue it's got to be real time as well, and that means more standardization. It means adequate infrastructure and very sophisticated analytical tools, and we don't have that today. Final point, I mean, I think it's the point Axel makes. We are at a point now where, for example, in Europe, we have the new political cycle starting up, and it is the right moment to ask ourselves, is all this regulatory change, which I would argue in the main has been necessary, but is it efficient? Is it actually hampering the development of our financial institutions, capital markets union, banking union, whatever? Well, it's the right time to argue and to analyze, is that the case? Have we really dealt with the sort of cross-sectoral effects, the spillover effects? And I think that's a big, big analytical job, but I think it's time to do that. So I would very much support what the sort of essence of what was said in the excellent report that Thomas outlined earlier on. I want to come back on resolution policies perhaps in the next round.
Thank you, David. Maybe from the supervisory angle, any reactions to quantitative impact assessment? I mean, the package is now there. You're seeing it being rolled out inside the banks. Do you see the difficult points? Do you see some of the overlaps and the duplications? And then perhaps also with the resolution exercises going into the banks, is it clear? Will we be able to flush these out with a quantitative impact assessment, or is that just a cost equation exercise?
Yeah. Yeah, obviously, a lot of the questions now are revolving around the cost of the regimes that have been put in place and the cost of complexity, and I think there isn't or there are very few regulators and supervisors who see complexity as a positive end in itself. But complexity tends to grow through the regulatory process, often through the desire to take particular circumstances into account, be they different business models, different jurisdictions, different market setups. So where we can target totally unnecessary complexity, where overlapping rules are trying to do exactly the same thing, and then maybe with extraterritorial impact creating conflicts, I think that's almost a no-brainer, but it's also very difficult to get done because while people talk about deferring to each other's rules, what they really mean is you should defer to my rules. And you know, getting that actually done, removing the overlaps is more difficult than it sounds. But there are some parts of this equation around complexity which are the result of a deliberate trade-off. And you know, when one goes down a route of reducing complexity, one goes down a route of more one-size-fits-all. We make the rules simpler, we make them less responsive to the types of business models and the variety of business models and risks, and you say, yep, that's simpler, it's less costly for the whole system, but it's maybe less, it takes less into account the other wish of differentiating, right? So you have this trade-off between simplicity and risk sensitivity, and between standardization and differentiation, and you have to try and find the happy medium between all of these sort of somewhat conflicting goals. So it's not as simple as just to say complexity is bad, let's make everything less complex, because we have you know, just as many people in the other ear saying, you know, please take account of our very specific characteristics. So it's not simple, but it absolutely should be a goal to keep the complexity at a reasonable level. You know, simplifying things down to banality will never happen in such a complex industry, and there will always be a cost of doing business in multiple jurisdictions, which is non-zero, and that cost has risen over the last 10 years. And the question is, can we bring that? Can we stop that cost rising? Can we bring that cost down to a certain degree without jeopardizing all of these goals, these twin goals of safety and security, simplicity, but also risk sensitivity and differentiation?
Dominique, any?
Well, quickly, indeed, an impact assessment is certainly necessary at one moment in the process to see where we are. But if we want to conduct an impact assessment, we should also consider the global starting point. Banks, from my resolution angle, obviously benefited from an implicit public support before the crisis. And the idea in building this new resolution framework with new expectations in terms of TLAC, etc., is to cut this link with the public purse, obviously. And when I saw some months ago that some rating agencies started to withdraw the implicit support from the ratings of some banks, one can see this as bad news in terms of capacity to access the markets at cheaper prices. But one can also see that the new framework is now in this implementation phase and understood by other actors who consider that indeed the public money is not here to be injected when things go wrong. And I think if we start to measure the overall cost of the changes, we need also to take into account these elements. Complexity on the resolution side, and in particular on the TLAC side, what matters is to understand that the calculation of TLAC or MREL starts from the supervisory side. So the idea is the two-step approach. At the moment of a resolution scheme, we absorb losses and we recreate a bank, we recapitalize a bank, which is up and running, so respecting its licensing conditions, so respecting its solvency ratio, liquidity ratio, etc. So we start from the supervisory side, and we add an extra layer. So the more complex the supervisory side is, the more complex the resolution side will be. So I think there's obviously an interaction here.
Yes, Axel?
One of the concerns we had in the last financial crisis was many of the instruments we had to rely on were untested. And I think we're there again. Because whilst I do appreciate MREL and all of these bail-in instruments, we haven't really had any experience with them. Actually, the whole issue of these instruments is very much supported by an unprecedented low set of interest rates caused by monetary policy. At the moment, if you want to tap markets, it's cheaper to get Tier 2 capital and debt into the market than it is to raise capital. Now, the dynamics could be quite adverse. Again, I think it was good that you could actually do the resolutions in your case by bringing in a third party and not triggering many of these instruments. But it's very clear the same investors who now hold some of these debt instruments also hold the equity. And at the moment in time where you transfer, where you transform the debt instrument into an equity instrument, they will feel their long equity. So they will short the equity. And then you will get very adverse developments in markets potentially. And we've seen that already when some banks, there was discussion of weakness and fractional weakness. You actually started seeing many short sales on the equity side because people felt that if they were to be bailed in, they actually hold more accumulated converted debt and equity of those institutions. So I think we also need to address some of these run dynamics and potential sort of pricing dynamics in a resolution. It's always better to hope that the resolution will never come around. But I'm not sure whether the instruments that are all in the market now, and we all go up to have, you know, in Switzerland, it's the, we have a 5+5, and there is some rebate on the upper tier of capital. We all hope that these will be well-behaved capital instruments in a crisis, and we don't know yet. So I think it is also important that when we look at these instruments that we don't fall into a false sense of security that next time around the system will behave more orderly than it did last time around. And therefore, I think it is important, as I was saying before, that we don't focus everything on the resolvability of the institution and its instruments in itself. Take, for example, you know, your institution. Again, it is an institution where the capital and the liquidity and the funding is built up over time, and we all hope we have sufficient time till the next stress in the markets to get there and to have these funds. That is much harder to do in a smaller environment where, for example, in Switzerland, there are two large banks, and the issue of sort of having some systemic solution with some funds that are set aside isn't as easy to engineer than it is in the European Union, where you have a huge number of banks and where you can do that. So I think what is important for me on the European side and on many of those is, let's look into not doing too much, don't put too much weight on just a single set of instruments. I think a broad set of regulatory measures for resolution might help us more than overly relying on more of the same. And we've seen that last time around. Actually, some of these instruments aren't well behaved. And I think you need to really seriously look into what would be additional measures that have more economic impact in improving resolvability than simply saying it's a quantum issue and we just need more of the underlying instruments rather than saying we need a diversity of instruments. I feel a bit we're going too far out on the wing and rely on a few concepts too much, rather than taking a robust set of instruments and bringing in a broader set of counterparties into resolution. And I find it categorically not very productive to create the impression that even under a global systemic crisis, taxpayer would not feel that there could be part of the bill that would be handed to them. We all want to avoid that as much as we can, but to categorically rule it out, in my view, in view of a potential systemic crisis, not an idiosyncratic one, is a dangerous thing to do because we haven't got the instruments that we can pull in order to avoid that categorically. So I think we also have to be mindful of the expectation we create with taxpayers. about what the next crisis will be. And we have to ask ourselves, are we actually well prepared with the instruments we have now in the official sector, central banks, regulatory authorities, if the next crisis were to come, and if it would be slightly different than the last one we failed. So I'm a bit cautious on creating too much of an expectation that we're much better prepared now, and in any case, taxpayers will not be part of the equation in the future. They will be the last part of the equation, but to categorically rule it out, I think is a danger.
Well, if I may answer, I hope I didn't give you the feeling that I was categorically thinking that everything is done and that the next crisis is over and won't occur and will benefit from all the solutions based on the idea that we ask the banking system to build more resources on the liability side. It would be a complete misunderstanding of what we think and what we are doing. And indeed, one thing is for sure is that we ask a lot to the banking sector, but it's not enough. There are other elements outside of the banks themselves which are absolutely crucial to make this resolution framework workable with more confidence in its capacity to find solutions. I think about, in the context of Europe, we absolutely need the third pillar of the banking union, the common deposit guarantee scheme, what we call in our jargon EDIS. This is missing, and this gives confidence to citizens who are also customers of banks. We need to rethink about the insolvency laws, which are still nationally based. And when we implement a resolution decision, the first thing we have to do is to compare with the impact of a normal liquidation, a normal insolvency procedure. And if we have to compare for a GSIB with 75 national insolvency laws, I'm sure that we'll find a country where it would be better to go to liquidation instead of resolution. So what to do in that case, except working on the official side of the things, not with banks, but working on the official side to find more consistency, starting in Europe, obviously, but not only, and also beyond Europe. So indeed, there are features which are not depending upon banks, but there are features depending on banks which are not capital-based. I think about data. You mentioned, David, the reference by Mario Draghi on management information systems. This is absolutely crucial. If we do not benefit at the right moment of a good quality and availability of data, how can we calculate any implementation measure? We can't. So I do not promise you that the next crisis will be done without any impact. A crisis is still a crisis. It's costly for everybody, be it a resolution, be it a liquidation. And indeed, it's not simple. It's complex, and complexity in the crisis will not disappear, obviously not.
Can I?
Yeah, maybe, just to pick up on these points, and that I think Axel is driving at on the resolvability side, and you know, I think what you're mainly getting at is the unsolved issue of how to implement plausible funding in resolution regimes. And you know, if I put my hat on as chair of the resolution steering group and look across the global aspect of resolvability for banks, this is the biggest gap still. It's the biggest gap, partially conceptually, but largely in terms of implementation. Because I think, you know, the capital stacks of the various instruments that have been set out, I mean, we know the direction. Axel's also right, to a certain extent untested, but you know, we know what we're trying to build up. I think it is in many jurisdictions still, to a certain extent, too much of a taboo. This topic of who is a lender of last resort, and to what degree are they there to bridge a temporary liquidity shortage in resolution? Because I think we are fine. You know, we now all understand that the temporary funding and liquidity needs in a crisis can be short-term, relatively extreme, and trying to privatize them in advance of a crisis and hold that liquidity on the balance sheet of a global institution will be prohibitively expensive. And I think that's what Axel is getting at when he says it's an illusion to say that there will be no role of state actors in a crisis. But when we talk about the taxpayer, we're often talking then about the taxpayer, in essence, bailing out the capital situation of institutions, and I think that is what we all set out to avoid. What nobody have said we want to avoid is a role for state actors, whether they be central banks or backstops to those central banks or funds that are built up to backstop these situations, helping temporarily get a troubled institution over the line from the beginning of a resolution to the end of a resolution. And I know that there are still sort of two camps out there conceptually. One that says that's also a taboo, and if we don't touch the taxpayer, it also means we don't touch the institutions that somehow work for the taxpayer as liquidity providers. But I'm not of that view. I think it's not reasonable to think that you will get through a crisis without bridging funding needs through the enormous capacity that state-run institutions can provide. And I also think that, ironically, the more you make clear that you will be prepared to do that, and I think you have some jurisdictions who have made that clear, the UK, for example, and the US has facilities in place which have not been abolished after the crisis. The more you are prepared to say that you've got an enormous weapon in your armory, the less likely you are to have to use it. As I said, still two camps and still an incomplete implementation. And as Dominique said, it is therefore not only down to the banks. It's down to the authorities to get their acts together, to say what is their strategy, and then to implement and communicate something. Because resolution will work when everybody believes it's going to work. When nobody believes it's going to work, it's not going to work. And so there's a lot about putting things in place, communicating them, and then saying, in whatever language is needed, that there is some kind of whatever it takes mentality that says, these are the tools we have, and we will deploy those of them which are needed in the volume that are needed to do whatever it takes to get over a resolution crisis, to continue systemically relevant functions, and still, I believe in this goal, avoid the danger of taxpayers suffering loss through bailing out and being liable for the losses of a private sector institution through filling capital holes. Because I think that's not part of the social contract that underlies banking. Banks have fragile balance sheets. They fund themselves short-term and they invest long-term, and that is a desired part of funding a real economy. Both services are desired, and therefore there's part of the social contract that says that if you do that for us, we will help you bridge temporary problems that are driven by the nature of these very fragile balance sheets. I think that's the contract. But the contract is not, you can do what you like, you can lose as much as you like, and we will always be there to fill the hole, because that has, we are still suffering today from the dramatic consequences of an interpretation of that in the pre-crisis phase.
Understood. Yes. David, you want to come in on this?
Well, I think this is the heart of the most important issues that we face in financial regulation. I think Dominique was very honest, and I very much agree with what Mark and Axel have said. Look, I mean, if the financial system is going to collapse, let's be clear. No matter what Dodd-Frank says or anything else, the public authorities will have to act. And when we look at these situations, the job is to minimize economic damage to the economy. Absolutely, taxpayers don't pay, but we've got to be realistic. And therefore I agree with what Axel says, that you need a holistic set of instruments here, the right incentives in order for the system to work. And it's work in progress. I think Dominique was very honest. I mean, do we really know what will happen in not just a small bank, but multiple bank crises over a weekend? Are we going to bail in? Are the COCOs going to work? You know, you've got to be fairly heroic to think all that's going to go smoothly. I mean, if it's a big international bank, a GSIB, you know, American law, as I understand it, says American preference. Will the US delegate its responsibilities to the authorities here in Brussels? I don't think so. If we have a major European bank with subsidiaries and branches all over the European Union, will there be ring fencing or not? Where some countries' GDP could be at stake. So these are massively important questions, massively important. It's unfinished. And I can't help thinking here that there's two key ingredients. One is trust. Second is law. And the third is institutions. And if you don't have those three, particularly for a cross-border situation, you're in big trouble. And that's what we have to build in Europe.
Yes.
Just one additional point. I think Mark hit the nail on the head on the issue we work on resolution. Because having been in the central banking community in the past, central banks should not kid themselves. If there is another financial crisis, there's only one institution that can be the liquidity provider of last resort. A lot of central banks dance around the issue and believe constructive ambiguity is the name to go. I think this is an area where, as we speak today, given everything that has happened in regulation, constructive clarity around funding and resolution and to what degree you can tap central bank windows will be much more productive. Because if we do not make that clear, the regulators, this is a complicated triangle between the bank, the central bank, and the regulator. If the central banks are too ambiguous about it in some constituencies, the central bank will not provide the clarity that the regulator needs. So the regulator needs to move to a worst-case corner solution where basically all they can rely on is the bank and its funding provisions in themselves. And if you look at the examples of the Bank of England, actually, if you look at the Fed, we just wrote a paper on the G30, Tim Geithner, myself, and a few others, where basically the Fed had its wings clipped on the ability to step in and provide liquidity against a wide range of collaterals. And the one thing that was clear from the last crisis, had central banks not moved into unorthodox refunding operations against a broader set of collateral. Remember, the Bank of England initially only refunding over gilts, whilst all the most complex structured products were in the ECB's window. The next time around, I think the central banks will face one big challenge. They'll be asked to fund against a much wider set of collateral, but the bigger issue is against a much wider set of counterparties. Because just assume for one moment that the next crisis doesn't come from the regulated banking entities, but comes from market-based finance, and there is a problem outside those deposit-taking institutions that by construction have access to central bank funding and to central bank funding windows. It'll be much harder to channel liquidity into those more market-based players. We did it last time around through what we call three-party repos. So most of these funds that run into trouble had banks and could channel their collateral through the banks into the deposit-taking central banks. That will not happen in the next time around because those avenues have been shut down. So I think we need, in particular now that funding in stress is no longer part of the business model. We used to provide, as market makers, funding into stress situations because that was part of our business. It's no longer. Who will provide that stress liquidity and who will provide access to funding and resolution if not the central bank? So I think this is an area where the current sort of constructive ambiguity can produce a counterproductive corner solution rather than providing some rules and clarity around around which we can build as banks our sort of stress scenarios. That would be important, but we're not yet there.
If I may, just to support entirely what you've just said, Axel, and also what Mark said, what matters, and I'm well placed to tell you that, because even if you said that the framework was untested yet in its all features, it was tested under their specific case, Banco Popular in Spain. So what matters during these has, when the resolution authority is in charge of taking the decision to intervene or not, because don't forget that the framework is based on the idea that, normally speaking, we intervene to provide for a better outcome than a normal liquidation. The bank is failing, so normally speaking, it's a private firm, so it should fail like any other corporate firm. The idea is to step in with extraordinary powers to prevent in financial instability, as an example. So during this house, if we are not persuaded to be able to provide for a complete scheme covering all the aspects, so using the famous write-down and conversion powers, using the bail-in powers, and to fall short because of a liquidity lack of support, no need to intervene, because we cannot afford taking twice the same decision, first to implement a bail-in decision, and 8 days after saying, oh sorry, but the bank will go to liquidation because it's unable to repay what has fallen due in between. It's absurd. So we need to gain this level of trust ex ante at the moment of the decision. We need to be sure that we can find all the bits and pieces to give a chance to this bank in resolution to become solvent and able to develop its business for preserving critical functions, etc. So yes, we need to have sufficient clarity ex ante, in particular on the funding and resolution side.
On that point, are the current structures and communication channels appropriate? Are they, will they foster the trust that may be required to overcome these kind of situations? Or the ring fencing, capital ring fencing are all signs that there is either not the trust or that the channel of dialogue or communication is not sufficiently strong or elaborated? Is there scope to improve that? Do we need to kind of reconsider the dialogue or deepen it with industry, amongst regulators, supervisors? Mark?
I hear that from time to time, you know, that if only we could talk to each other more and trust each other more, it would, we would solve these problems. That's really bullshit. The idea that as regulators we don't like each other or trust each other or talk to each other enough. This dialogue has never been more intense. We understand each other's positions very well. But let's face it, there is a dilemma between home and host supervision, which you can't solve just by liking each other. What you can solve through knowing and liking each other is being able to understand each other's positions in advance and to be able to operate in a crisis and to know, exactly when, somebody on the other end of the telephone says that they will do something, whether you have a feeling they will do it or not. Right? And that is important. But in the end, just through being well networked and talking to each other, it doesn't resolve this basic dilemma that you have global groups, conglomerates, operating in national jurisdictions, and the supervisors in those jurisdictions have, as part of their legal mandate, in the first instance, a duty to protect the creditors of the local institution. That brings us automatically into the attempt to resolve this dilemma. And as the home supervisor of two of the largest groups in the world, we're sort of passionate about trying to promote the concept of having as much of the resource set of the institutions, be it capital or liquidity or what have you, centralized and available in a fungible fashion to fill holes wherever they come up. But at the same time, being the host of other institutions from around the world, we understand that there needs to be a certain level of security at the host level, and the standards the group I now lead put out a few years ago on TLAC and the internal distribution. That's the first time actually that the standard setters have tried to get to grips with this problem. It's not a new problem. It's an old problem. It's just everybody kind of ignored it in the past and thought that everything was fungible. And then we realized in 2008 that the world doesn't work like that. But the Basel standards on capital have spectacularly ignored this problem through their entire life cycle. They've always attached themselves at the so-called consolidated level. So how much capital does a group need, and has left it to national discretion as to how you drill that down. And the FSB standards on the distribution of TLAC, which covers both going and gone concern capital, to use the jargon, is the first time one has tried to delve into this very tricky topic and talk about how much should be pre-positioned. And I think there it's about the structures of groups, it's about how entwined they are, and I think just to make a side remark, a massive advantage of this whole resolution planning exercise is that these global groups they understand themselves much better and have simplified themselves down to the complexity they need, because there was a complexity that was totally unnecessary for the running of the groups themselves. So things are much better understood than they were, but this basic dilemma about where do the pools sit and how are they pre-positioned is in the nature of running a global conglomerate. And it's so working on it and understanding it is key, but it's not through lack of trust and dialogue. It's through a basic dilemma that you have to find a way of negotiating or solving in a way which in the end will result in a sum of the parts problem. It will result in the sum of what you have to hold in all of these parts being greater than the total, because there is no way of deleting the mandate of the host supervisor to protect the creditor of their institution, and because otherwise they're not doing their job. So,
Axel.
But Mark, it does lead in an extremis to the question, and again, you can call it trust or you can call it whatever, but it does lead in extremis to the case that if there is a corner solution with close to 100% or 100% pre-positioning, it leads ad absurdum the entire effect of single point of entry. And that's sort of, that's, and again, that is, you might not say it's a matter of trust, it might just be the mandate of organizations that need to look after their own constituency first, and we haven't really embedded in the international rule a set of collaborations that would make single point of entry more credible. Yes, we're trying, and it's very clear. There's a very clear trade-off. If you only pre-position 75%, you do have sufficient additional capital at group that you can keep to channel capital where it's needed. If you go close to 100%, everything is a more than the sum of the parts discussion, and that does lead to a debate between the regulators. It's not the bank has to do what we're asked to do, but that could be helped by having a clear set of rules for international global active banks where there is a set of rules and where everyone complies to these rules. If single constituencies go to the extreme of one of these corner solutions, there's a big incentive for everyone doing it, and if everyone does it, we lose single point of entry. That's the concern I have at this moment about the issue.
I fully agree with you that exactly as if everybody goes to 100, then you are starting to put in question the benefit of running the conglomerates, right? But going to zero is asking for way too much of this kind of trust, right? Zero, and so, you know, that's why I said the group that I now chair, you know, sort of went onto this very difficult ice and had long negotiations about what this range should look like, and came up with this 75 to 90. But there's a big difference between 75 and 90, and now we're getting very technical in this talk, right? But you know. We also, from our perspective, are believers in going to the bottom end of this range as being enough to fulfill the mandate of host authorities and give enough fungible resources at the center of groups to be able to shift resources around as they're needed, and then the whole thing works again. Right, so it's a question about, you know, how you calibrate that, and you can say it's sort of about trust at a meta-ebene, but it's not about interpersonal trust. It's about trust of how legal systems operate, and you know, are you prepared to believe that the resolvability of the group and the resolution authority is credible enough, and the group is well capitalized enough, that the chances are low enough, and that to bring your demands down to the lower end of that range. And I think there are a number of bilateral conversations that have been had in crisis management groups that have gone exactly along those lines. There are other bilateral conversations that have not yet gone along those lines. So, you know, work in progress and very important.
But I think Axel is right, logically, that in these enormously complex institutions in resolution, you need strong global institutions to assist. And I would go further. It has to be on the basis of enforceable law. But nobody's going to accept that. Least of all the United States. So we're automatically in a second best situation where the law is not clear enough. And if the law isn't clear enough, the trust will not be there. Creditors have to know that they're going to be treated fairly. I don't think the law is clear enough that it's saying that in a complex resolution framework. So I come back to what I said. I mean, it's law. The trust comes from the law and the institutions. And if we rule out strong global institution with enforcement powers, then we better work out something at regional level that is really going to work. And I think it's essential that there is a court of law somewhere which can decide on a fair and equitable basis. I'm not sure we have that.
And I think one of the points I would hazard a prediction, if you like, that a big resolution of a major institution, you know, as long as it was within the bounds of fantasy in the scale of the losses that had to be absorbed, will probably work. I mean, although things are untested, we'll get it to work once. The biggest question is what happens afterwards. You know, so we've resolved, you know, and let's say it's an idiosyncratic crisis. We've resolved GSIB number one. But then all of the creditors of or the holders of the instruments who've been bailed in have realized what that really means, and then you've put an impulse into the system, which is absolutely the desired impulse. But the question will be, how does the system react to that, and what happens to the financing of the institutions, and what happens to the legal in the legal aftermath, right? Because one thing that is as certain as amen in the church is that we will then spend years being sued from all sides, right, after one of those resolutions, because everybody will feel that they were unfairly treated. So I would say actually one of the next most important phases is the aftermath of the first big resolution, and what does that tell us about how robust a concept that is for the long term?
Okay, to be tested. Dominique?
Yeah, no, just something which I think was not yet mentioned, but against these risks of fragmentation and absence of a sufficient law, etc., there's also a step in the process, which is to organize dry runs, to see the pressure points, to analyze them, and we do it. We did one very recently, 2 months ago, beginning of this year, around a fictitious bank in the Nordic Baltic countries, so partly within the banking union, partly in Europe. And we tested the 4 key areas. If we want something to be workable, we need to test the governance based on the legislative framework, that's true, so institutionally and concretely on the case-by-case basis. The capital, so this is the question of prepositioning, internal TLAC, MREL, liquidity, obviously, funding and resolution, and it was mentioned by you, Mark, communication. Because a disruptive communication process can immediately stop any chance to achieve a positive outcome for a resolution case. So these are key elements we know, and we want to test them based again on stylized cases or fictitious names to be sure that at a minimum we give us the maximum chance to implement these famous difficult frameworks. And then the second case will be difficult. But again, when we started with the current European framework, BRD so-called one today, everybody told us that the Single Resolution Board won't be able to implement this framework, etc. Under very specific circumstances on a national basis, we did it. So it can work. Don't start with the idea that it's obviously already impossible to trust these new rules negotiated at the international level and then implemented in the different areas. I think we can still keep some optimism, but reasonable optimism, not considering that indeed the next crisis will be just easy to resolve. Obviously not.
If I may, in the sort of final set of questions or question, we've just discussed the big challenge that remains before us with the existing framework. Looking perhaps a little bit more into the details of the rule book, there is complexity, there is fragmentation, also in the way it's implemented across jurisdictions. The FSB has recognized that and is launching an initiative to collect these instances. Perhaps very briefly from you, which would be the instances or the regulatory difficulties that are in the current framework that you think are susceptible to be taken up, and how strong do you see the capacity of the FSB to actually reverse some of these ring fencing or duplicative or national options implementations in a national framework? Mark, I'll start with you.
If you want one example, I think it's the best example, because you're dealing with a globalized market, which doesn't work well if you don't have globalized rules, and that will be the derivatives reforms, which have been been put in place really only since the crisis, based on a common goal, well defined in ways which differ from each other and compete with extraterritorial effect. And that's the whole chain of derivatives regulation, including the clearing thereof. So this part of the plumbing of the international financial system has been, to a large degree, newly regulated since the crisis, and I think it's acknowledged by everybody that the fragmentation is detrimental and we've done a bad job. So I think that's one area that you've got the most chance of attacking successfully, because the complexity is pretty obviously unnecessary. And I think there are a lot of other elements of the complexity in the system which are not, which where the complexity has been driven by somebody with a particular interest, and that person is still in the room and will scream if you try and take it away. So I think that's the most promising area and you know, one of the most important areas.
Well, I think for us the challenges are threefold. The first one is, and I think we've seen some of that, regulatory differentiation in the timing or in the requirements that are levied by different constituencies. And that is difficult to deal with, because if you're on various sides of a transaction, but you have different requirements on these types of transactions depending on constituency, you know, some of the derivative rules, for example, come in here, it makes it very hard to take location decisions. Very clearly, I think the second one is on extraterritoriality, which again is something for global banks we just need to face. Obstacles, for me the biggest obstacle is cross-border information sharing, because there are still national laws that even if you want a holistic look at the client, sharing that information across parts of the bank will be very difficult, because information is very often ring-fenced in constituencies. So to have a consistent view as a global bank about a single client who is in multiple booking centers is going to be very, very difficult and requires information sharing rules, which we not even seen the start of negotiations among the regulators. So I think there's more in the pipeline. At the moment, I would just say the cost of running a global institution are relatively high. We're all in a league of our own in terms of too big to fail and global systemic banks. But I think given that the journey so far hasn't really led me to believe that we will face a single regulatory requirement and a single rule book and no national jurisdictional implementation, the next round of what we need to do as banks is optimize our operations across constituencies. So we take another look again at the business model. What do we do where? Do we exit certain products in certain markets and certain activities in some constituencies simply because the capital, liquidity and other requirements plus the complexity of operational in operational space are so high that the design of an optimally reacting bank to these various jurisdictions might be different than the design you started with. So I think in the end, once the dust settles, we will all have to re-optimize so we use capital efficiently. If I give you a last example, at UBS Group, we're basically allocating capital to jurisdictions, to businesses and to products where we get the highest return. That is the large motivation. And if we find that there are different jurisdictions where allocating the same amount of capital leads to less of a return for very similar business, we're just going to allocate it where the return is higher. And so that will be a very important outcome, that the landscape of banking could look quite different. And that's where I'm concerned that if I look at first order approximation now, where profitability has evolved a lot, it's very good still in the home market. So that is Lucas Gavilas here, who used to be in charge of our Swiss operation. That is a plus for many of the Swiss bank. But then it's Asia and the US. If I look at allocating capital to European operations, it's much more challenging. And so I think, and that's different maybe for non-Swiss bank than it is for us. But that's going to be the key decision in the future. We're going to re-optimize our capital structure once the dust settles on capital liquidity and resolution.
I think we're running close to running out of time. I don't know, Dominique, will you?
Well, just
very briefly.
One sentence about this question of timing of implementation. I would like to insist on the idea that at a minimum for European countries, this notion of resolving a bank, again on the resolution side obviously, is a completely new concept. We cannot say that the FDIC is in charge of resolving banks in the sense of a Title II, obviously, but the FDIC was in charge of finding solutions and was created in 1933. The first rules building on new concepts like TLAC, like Bridge Bank or things like that were created 5 years ago, and the BRD1 adopted in July 2014. So I think this timing implementation is to some extent unavoidable, because banking structures were not ready and the institutional side did not exist yet. So that's why, in particular at the Assemblée, we've decided to implement a staggered approach for MREL, building on transition periods. But the idea is obviously to find a consistent approach at the end of this transition. So I think this should be also taken into account. We cannot be immediately aligned because the starting point is completely different from one area to the other.
David,
Finally,
final word?
well, I was going to say that simplification is very seductive. And Axel's absolutely right. We want to have fit-for-purpose, efficient regulation, which does not sacrifice any of our basic prudential principles. But it's difficult. Don't think it's easy. And to prove the correlative effects between all these different instruments, what works, what doesn't, what impact in economic, very, very difficult to do. And as I was saying yesterday, is nothing more inflexible or inelastic than law. And European law is perhaps right up there. Implementation, parallel implementation, well, let's have regulations. That's what a single market should be about, not directives. Let's have regulations and really build a common European capital market. And three, allocate and delegate in a sensible and mature way responsible powers to the European supervisory authorities. They've done a fantastic job so far. They've proven they can do it. And there's no reason not to allocate, where it's necessary, more powers to the European super. Final point, technology. I think technology, it's a point in the paper which I really commend. I think technology can be immensely helpful to improve the efficiency of regulation in the future, whether one thinks in terms of, reg tech or blockchain providing real-time data to regulators. We ought to look at the data again. We've got far too much data, most of which is absolutely useless to regulators. Let's refocus on what we really need to find out whether there are risks in the system.
Thank you very much. I think that brings this panel to a close. I won't attempt a summary. I think it's been a very enriching discussion. I'm grateful to the panel members for their dynamism and interaction. It's made my life certainly a lot easier as a moderator.